Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katsimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, I'm Mike Stoller. I don't know why I'm laughing. I'm with these guys over here, and what we're trying to talk about is the outlook, these executive outlook for 2009. And these gentlemen really must be very positive. So hopefully in the next half an hour, they will tell us what their thoughts are of where 2009 is going to be. My first guest is Joseph Harbert, the regional head of Metro Region of Cushman & Wakefield, Stephen Siegel, chairman of Global Brokerage for C.B. Richard Ellis. The name is still there today. Steve Witkoff, with CEO and Grand Poobah of the Witkoff Organization. And last but not least, visiting us from Encino, California, Harvey Green, okay, President and CEO of Marcus & Millichap Real Estate Investment Services. So since I joked about this, how's the world in California and the rest of the world, Harvey?
About the same.
About the same? I mean, how bad are we?
Well,
can I polish my apple?
Absolutely, but my perspective is a little different, I think, than these gentlemen's, in that most of our transactions are under 20 million. There's been about 15,700 transactions so far this year.
So you're saying sales are still taking place?
Sales are still taking place, albeit, though, they're down dramatically. And in the world that I'm in, apartments are still the darling. But there's a lot of drivers that are outside.
Here's a man. I know we call him Chairman Global Brokerage. How many apartments do you own in the New York area?
90 buildings.
90
About 6,000 apartments.
6,000 apartments. So what's your thought of the apartment business?
It's been very, very good for me.
It was very, very
yes,
good.
I don't know where it's going. We have affordable apartments in the Bronx. That's the substantial portion of our portfolio, so we feel pretty comfortable that that will be sustained its value over time.
A lot of debt?
Nope.
Leverage? High leverage?
Nope, not highly leveraged, and leveraged through 2012 before we need to look at any refinancing. And every one of the buildings that we set up as a separate loan, so we can refinance single buildings at a time.
Steve,
that was unintentionally.
Once you practiced law, then you went into the apartment buildings, the Bronx, Washington Heights. You still have any apartments?
I do a few.
So what's your thought about? I mean, Harvey's saying that the apartment around the country is still a positive element. You haven't seen apartment rents drop yet?
It depends. And, yeah, some of the submarkets we have, but it's of all the product types the one in which we think there's positive, or continues to be positive growth.
Have you seen any drops?
In the Bronx, candidly, our rents can't drop. We bought on an average $800 a month, so even an increase takes it to an area where others drop. And we have a building, 2 buildings on Columbus Avenue, and frankly, they've held their rents at a very substantial level.
Which is interesting. And what about the, what about the office market? I mean, you've sold buildings. You said before you sold a couple of buildings over the last couple of years, and what's happening with the office market today?
Well, there's no question the office market has slowed down. The leasing velocity has slowed down. I think there's somewhat of a herd mentality. A lot of people are holding back, waiting to see what happens. I think some rents that have dropped more because of a fear of what might be versus really looking at the fundamentals of the supply and demand. We're still at virtually single-digit availability.
Yeah, but look at the unemployment. I mean, availability is there, but what happens when Merrill gets consolidated into Bank of America, when AIG gets rid of a number of their employees, when Wachovia and these other banks, and there's no more brokerage, and where are we? I mean, what's happening? What do you see in the tri-state region over here?
I see, as Steve said, the leasing velocity is off about 14%. We haven't really seen the effect yet of big layoffs. In fact, there was job growth in New York City the first 4 months of this year. Obviously, that's come to a halt. I think tenants are taking a different perspective on the market, more of a wait-and-see attitude. We've seen a lot of short-term deals getting done, a lot of 3 to 5 year renewals on deals, and some adjustments in pricing.
Well, landlords are proactively going after tenants to say, I'll extend you for a couple of years to stabilize their buildings until they feel the market will turn around, quote unquote. For example, Heller Ehrman, to just give you some insights, Heller Ehrman went
California law firm.
Well, went bankrupt, put their space on the market, or directly went back on the market through Boston Properties, and is gone already in less than 90 days. 100% leased to a law firm at, I know, very solid numbers. Maybe less by 20% than it would have gone 6 months ago, but leased very quickly and to a top law firm. Comcast just signed a major lease for 95,000 square feet. There's several deals between 200 and 300,000 square feet out and pending in Midtown. And a number of deals downtown. There'll be a deal announced downtown of substance tomorrow. When is this show on?
2 weeks.
Okay. Well, a major German bank has signed a lease downtown at 7 World Trade for north of 100,000 square feet. It will be announced at a press conference tomorrow. A number of not-for-profits, United Jewish Congress, Interactive Data Corporation, which is not a not-for-profit, signed at 100 Church Street at decent rents. I mean, no, empty my pockets and give up the store.
But Joe was on a panel with me last week, and we were talking about the region and other places. Everybody is saying rents are going to drop by 20%.
We think there'll be an adjustment. We haven't seen it yet. In fact, rents actually went up through the month of August. So you just started to see a decline.
Hey,
if I'm a
tenant, unless I need to lease space, I'm not going to run.
If rents dropped by 20%, they went up 100% in the last 3.5 years. At least 100%. Average asking rents from 40-something to 86 and change. And if you go down only 20%, in my opinion, with the supply that is going to be delivered versus what will be a resumed demand at some point, you will be very quickly back up in the high 80s or better in Midtown.
It's always great to have an optimist over here.
I noticed you cut back here. I didn't get any makeup this time.
No, I'm sorry. We had to save a little bit, but but what I'm saying is, maybe I've become the ultimate pessimist. Maybe it's too much walking around every day, and I hear lenders not wanting to lend, people saying that they don't want to. Everybody has a scared mentality. Is that the way you're seeing it around the country?
It's all about financing. I mean, first of all, our business is all about cash flows. So depending on how leveraged or unleveraged you are, I think that's a big part of it. I think Steve said it well when he said, look, he's got the right financing in place. He's not over-leveraged. Each asset has its own individual loan. We all know a lot of people that are cross-collateralized, over-leveraged between 2006 and 2007, and for all intents and purposes right now don't have an equity.
But let's look at Witkoff. Witkoff had some properties that he could have built on. The lenders say to you, Stephen, maybe you want to put 20%. They say, Steve, if you want to go in there, even in your good friend Sam Jerusa from M&T, I need 35 to 40%. And there's another thing I need from you. Recourse, a guarantee. When was the last time you've heard about guarantees until 2008? Harv?
Yeah, the early 90s.
Steve?
Well, they're back with a vengeance, but I don't think, I think the bigger issue is underwriting standards today. We're way past LTVs and 1-2 coverage ratios. And I agree with what Steve said. He bought his portfolio well. I mean, Steve is a smart guy. He's very prescient. He saw an opportunity to buy in the Bronx. But here's the nightmare scenario, and this is not a knock on what Steve was saying. It affects us all. In a deflationary environment, and that's the kind of environment we're in, where asset prices are coming down every day because you can't finance them. And once you can't finance them, the prices come down, and that's the kind of spiral we're in. And when you have job layoffs begin to affect even people in the Bronx and Washington Heights. And as cheap as his rents are, and they may be cheap portfolio-wide as compared to everybody else, if one day people can't pay those rents now come from $800 to $600. And what you're beginning to see, Mike, in the marketplace is when you go to see a bank today and you say to them, I'm buying a great deal. I'm buying in the Bronx for 5 times the rent, and last week it was 8 times the rent. You're going to finance me 60% on that, right? And the statement from them is, well, but have you stressed your model for rents coming down 20, 30% from there? And that's what they're beginning to say. That's the fear mentality out there. So I think it's got to be reversed, and that's why you hear guys, the Fed chairman talking about quote unquote quantitative easing.
I mean, look,
people are
I've
really
been spending
scared.
some time with some young guys who run a debt fund, and they say, we're looking at transactions. They've raised money from insurance companies and other places. They said, we don't know. We're afraid that if we put out the debt today, the value of that property is going to drop down tomorrow. They have a valid point. Now, last week when Mike Fascitelli was here, and I said, Mike, you invest in mezzanine debt and this. He said, I'm not really investing that much in mezzanine debt. I'd rather buy something. Larry Fink, speaking at the NYU Capital Markets Program, put it bluntly. He says, why should I invest in real estate or real estate debt when I can get 15% on a Verizon bond? How do you answer that when somebody, hey, the way Marcus and Millichamp, or the way CBRE made money in Cushman was investment sales. You had that buyer, somebody was hungry. I mean, the Israelis, when they bought the Plaza Hotel, all these people, they had, what happens now? What happens with all these investment sales brokers that you have on the street around the world?
Well, for us, the issue is really that the average transaction is small enough, and the drivers underneath are a little bit different.
Harvey, even if the transaction is small enough, if the local banks get hit, even in California, Lou Ranieri is a very bright guy. Did he expect Franklin S&L to go bankrupt? Chorus, they're one step in the crapper. I mean, I was sitting with guys who were saying, we just gave some money to WAMU because our friend became chairman of the board of WAMU. Having dinner, it was the most indigestion was at that night when WAMU was taken over. I don't think that even the small transactions are going to be financed that well.
Well, but we see a lot more of is their exchange transactions. They aren't highly leveraged transactions. And as I said, the drivers are more around preservation of wealth or passive income stream. So we see an entirely different
You
format.
oversee the capital markets of Cushman. Okay,
I just want to reflect on something you said. You're talking about a scenario that exists today as if it's going to be the way of the world forever. As if you're going to get 15% Verizon bonds, or for that matter, 18% Vornado bonds on a discounted basis, or SPACs that you can buy 12% tomorrow morning.
White Land America, the title company, going to business because they invested their 1031 money in auction rate securities.
But the point is that's not going to last forever.
Yeah,
and fundamental real estate transactions will come back to the forefront.
So when do fundamental real estate transactions come back? How much were our investment sales of your region down this year?
60 to 80%.
How much the CBRE?
Same.
60 to 80%. Yours?
Same.
Okay. How much did you buy this year?
Nothing.
How much did you buy this year?
Nothing.
Hey. So
But that also reflects a viewpoint you've got to have a view of where you think a market is going. If Steve, I think, if Steve felt, and this was part of our discussion before we started filming, what's going to happen with New York City? Who's the next mayor? What do the quality of life issues look like? Does crime spike? Are there going to be garbage pickups with the frequency that we have today? Or are we going to revert back to some of the issues, quality of life issues we had in the 90s? If you have a sense, why do you buy real estate at a 10 cap today and leverage it to get a 15 as opposed to buying a Verizon bond? If you believe that things are going to be good in New York and $800 rents in the Bronx,
Stephen, I'm not disagreeing with you. I'm just, Larry thinks BlackRock is a very bright guy.
But again, you're talking now, and I agree with Steve. Ed Gordon, rest his soul, talked about quality of life versus business cycles. And when a quality of life comes to a city, it's not a 3 to 5 year cycle. It could be 20 to 25 years, and it takes disaster scenarios. We survived 9/11, and the quality of life here continued. I believe we'll survive this downturn and the loss in revenue to the city, because the administration, current or future, understands that they must maintain the quality of life that we've created in New York City, or it's going to be a vicious cycle.
And
it's going to self-fulfilling prophecy.
Is it accurate? Is it accurate that we've had, at least up to now, less job loss on Wall Street than we did in the late 80s, early 90s?
Yes, and all we have are predictions of William Thompson's predictions of 200 and some odd thousand.
But that's even still less then, right?
Yes.
What was the job loss in the 70s?
350, 350.
So, I mean, right, and the one...
At a much lower base of jobs, I mean, a bigger percentage.
And for sure, what nobody discusses is that you're not going to see any new development out there, that's for sure.
So what's going to happen...
You're seeing the last one on 42nd and 8th right now.
What's going to happen? What's going to happen in 2009? How do you see a recovery? Where do we see a recovery in 2009? Or as the guys last week said, it's going to be a couple of years before we see a recovery. What do you see, Harvey?
We think that 2009 is going to be pretty similar to 2008. So, in terms of a recovery, we don't think it will be a recovery in 2009.
You talk about tax-free exchanges. If they're not doing things, there aren't going to be too many tax-free exchange deals.
Well, again, you're focusing on one aspect of it. I'm focusing on a different aspect of it. Baby boomers are still aging. They're still having to deal with a lot of issues. There's a lot of them still are shifting from assets that are more management intensive to assets that are a little more passive. We're still seeing a lot of that taking place. So the driver is not a fundamental real estate transaction. The driver is a longer term horizon for estate planning purposes, or again, preservation of wealth purpose. And I agree with Steve that today you're looking at it in a snapshot. I would agree with you. Over a longer term, I think the fundamentals will come back.
Since I would say that most of us, or all of us, are baby boomers, would you say he's going to invest in a strip shopping center? Or is Joe and I going to invest in a strip shopping center as a preservation? I'm a little worried about investing in any real estate today.
Well, I understand that, but there are...
The fundamentals are sound. I'm still not worried about investing in real estate.
There's a lot of people who look at different parts of the country as emerging in particular product types and not collapsing. I'm not going to buy a condominium in Florida right now.
No, and I'm not going to buy something with a cap rate that isn't absolutely acceptable to me.
Right.
That I can have on a leverage basis, assuming I can get the leverage.
But apartments
immediate
are still
cash
very
flow,
strong in
which is a different world.
But Harvey, you might buy a condominium in Florida today at $100 a square foot. And if the market trades to that level, guess what? It's going to open up. That's what happened in the 90s, Mike. And look at the recent home sales in California. Recent home sales in California for the first time last month spiked, big time. And why? Because this stuff is cheap out there today.
I would buy, if I had a fund, I would buy a pool of houses on a discounted basis that have been possessed or repossessed or foreclosed on. And I would rent them out or hold them. Because if you can buy them at 30 cents or 40 cents on the dollar and sell them later at 60 cents on the dollar,
I think Steve, what you're saying is interesting, but the reality is that the banks haven't yet put those properties on.
No, it's beginning to happen, though.
But it's going to happen.
We run a screen in our office. We have a screen in our office on New York and Southern Florida, where we study every single construction project in Southern Florida, and we think the market's it's going to happen like this in New York too, within the unsold share market. Same thing that happened in the 1990s. And the screaming green light to buy happens when the after-tax cost of ownership equals the cost of renting. And when you get to that level, everybody's a buyer. That's exactly what happened in the 90s. And now, by the way, there are different tax deductions that you get. Florida.
But I agree with you, but I have to disagree with you, because Steve Ross said last week that it's hard to get mortgages today for individuals. A lot of condos around the country are blowing up because people, when they went to contract, they went to contract for 90% financing.
I'll give you that has to change. The government is telling the banks to get your balance sheets in order. At the same time, they're telling them to have stricter requirements as it relates to lending. They don't balance. They don't equate.
And Steve's right. And in the market we're talking about, when prices come down to that kind of level, you're well within Fannie Mae and Freddie Mac limits. Well within. What Steve is probably referring to, Steve Ross, are jumbo-type mortgages. And by the way, jumbo mortgages, I sold 2 apartments at 55 Wall Street in the last week, and both were financed with 75% financing at slightly sub 6%. So, on jumbo deals, these were $1.5 million sales, and with $1 million mortgages financed at sub 6. That's what's happening now. Now that you have this. It's not the TARP, but it's the TALF and all these different. This is all the quantitative easing that is now loosening up the mortgage market out there.
What are we seeing in hedge fund world? The Westports of the country, the Greenwiches, and what's happening over there, where people bought buildings at these ridiculous prices? Are vacancies happening yet? Some of these hedge funds are going out of business.
You're starting to see a lot of signs. You're seeing a lot of retail signs out. You're seeing vacant storefronts. You're seeing some trouble out there. But I think that's going to be something that's going to occur for the next 6 to 9 to 12 months. I'm really encouraged by the fact that we have the election behind us, and that you have apparently solid picks for a cabinet. And you're going to have
early picks,
and an administration that seems to understand that there can be no lame duck period here. And I think you're going to see a very active Congress. You're going to see a lot of bipartisanship occurring, and I think that's going to be very positive. These things are going to move forward and be
and it's a worldwide situation. All the governments are involved in maintaining, sustaining, and improving their economies.
I mean, Mr. Woodcoff has invested in Europe. I mean, if you think the debt market is bad in America, there's no debt in Europe.
None.
There's absolutely no debt. I don't know if you do business in Europe, but nobody can get debt.
It doesn't exist in Europe. But you know what? You're picking up on something I was about to jump in and comment on, and it's what Steve is saying. I think in the United States, we are so far ahead of everybody else. I read a fascinating editorial in the Financial Times. I think it's a great newspaper. I read it every day, but it's a great editorial about how for the first time in, I don't know, maybe 3 decades since the 70s, since the crisis in the 70s, and I wasn't around for that, Steve, right? You were, and that was a pretty.
That was around for 29,
and that was a pretty. That was a pretty dreadful time.
Yes.
But for the first time, you have the Fed and the Treasury working together in concert, fiscal and monetary policy, and these guys are very coordinated. You don't see that anywhere else in the world. The ECB operates completely separately from how each government is operating in Europe today, and that's why they are so far behind us. So that may well be a saving grace here. I mean, there's just huge measures that are in a very coordinated basis are being are happening today.
And it's
I hope New York City, by the way, I hope New York City and New York State act like that as well. I happen to think, for instance, that Governor Patterson, everything he's saying has been wondrous. It's
Yes.
Let's get off the political and let's get more on.
Nobody's talking. It is the political.
Invest behind government.
I understand, but I want to.
You can't separate them anymore.
I want my viewers to get an idea. Harvey's very positive on the multifamily. Steve's very positive on the multifamily. I think everybody is a little down on the office. I think we're all down on the office. What about retail? I mean, this year you had Linens and things, you had Mervyn's, Stephen Barry, you know, Circuit City, and we haven't seen...
Forever Young, you have a lease out Forever Young right now, 100,000 square feet at 1540 Broadway, which is more than likely to get signed.
No, it was signed. It was signed. They brought it up on the show.
I don't know if it was officially signed. Because a week ago they said it wasn't yet. I can tell you at 11 Times Square, there's an offer in at $575 a square foot for 15 or 18,000 feet of retail on 42nd Street in Times Square from a credit-worthy retailer. There are empty stores. You walk up Madison Avenue, you'll see the Sharper Image store hasn't been leased in 2 years.
But you know,
there are spots that are problematic, but overall, the city is still thriving.
What about
Actually, sales on Black Friday was up 7%.
Nationally, retail's under great stress. Mom and pops are under a lot of stress. And as you commented, Michael, there's a number of chain stores that have closed.
These vacant stores are going to make it a little difficult over there. So if you had money to invest, because as Mr. Siegel said, at one time he was wealthy and comfortable, and now we don't know where he is, and we couldn't even get a makeup today.
I grew up in a one-bedroom. When Steve told his story about declining rents and people out of work, I remembered my father, and the rent was $54 a month, and he was 3 months behind in rent because he was laid off from work.
I wish I could ask
brought back a memory as a kid.
I wish I could ask the question.
You could see that again.
But
I know.
But I got the cue card saying that I must say goodbye. But I'd really like to thank Joe Harbert, Steve Siegel, Steve Witkoff, and Harvey Green for being here. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.